Welcome to Raise the Bar, elevated conversations around entrepreneurship, capital raising, and real estate. I'm your host, Seth Bradley. Most real estate investors think that money is in the asset or in the property, the location, the asset class, the market cycle, and of course, all those things are important. But the owners, the operators who consistently build wealth over long periods of time and don't get washed out by the economy through the market's ups and downs, the rising rates, the recessions, they're the ones that will tell you that money is in the structure, in how you structure the deal, and what creativity you can use to get the deal done. How you structure your fund or your acquisition, how you raise capital compliantly, how you establish rapport and relationships with brokers and sellers, how you manage and ultimately operate your assets, of course, as well. That's what today's conversation is all about. And if you're building a portfolio, you're running a fund, you're managing assets, you're raising capital, to do it the right way, listen up, you're going to want to take notes. Let's get into it. What's up, builders? This is Raise the Bar Radio, where we talk about building wealth, raising capital, and all in all, raising the bar in your business and your life. This is the No BS podcast for capital raisers, investors, and entrepreneurs who are serious about scaling their business and living life on their own terms. I'm Seth Bradley, securities attorney, real estate investor, and entrepreneur, bringing you world-class strategies from the best in the game. If you're ready to raise more capital, close bigger deals, build a better you, and create true financial freedom, you're in the right place. Let's go. Today on Raise the Bar, we've got Cherif Medawar, real estate investor, fund manager, best-selling author, and one of the most experienced commercial real estate educators in the country. Cherif has been actively investing for 35 years, built a $100 million portfolio across the U.S. and Puerto Rico, launched and managed multiple real estate funds, and trained thousands of investors through his FAX system and CMREI platform. He's widely known as America's #1 commercial real estate deal maker. Cherif, welcome to the show, brother.
Thank you so much, Seth. Appreciate you having me.
Oh, for sure, man, for sure. Where are you tuning in from?
I just came from Puerto Rico. I'm in Los Angeles.
Oh, awesome, man. So you frequently kind of go back and forth between those two locations? Those are your two kind of home bases?
California and Puerto Rico. I'm officially a resident of Puerto Rico because of a lot of tax benefits and I have a big portfolio there.
For sure. Yeah, a little different than California, I think, tax-wise.
Yeah, big time. Yes.
So, this is a question that's a little more difficult for folks like us, a little easier for W-2s and folks like that. But when somebody comes up to you on the street and asks you what you do, what do you tell?
I used to tell them I raise capital because then it begs the question, oh, for what? Oh, for real estate assets. And then they say, well, so you buy with groups of people? Oh, yeah. I don't know if you know, but there are real estate funds. We raise capital, group the investors together, go into cash flowing properties, and they have to be accredited, and it starts the conversation. That's what I say.
For sure. Yeah, where are you at nowadays? Like as far as raising capital, buying real estate, are you still in kind of growth mode? Or what are you seeing out there, especially with the way the market in CRE's been lately here in the States for the last few years? They said survive till 25. We're in 2026. We're still surviving. What's your commercial real estate business looking like right now?
So my commercial real estate continues to be twofold. The portfolio that I personally hold that cash flows steady now through the years, it's been like 20 years that I'm building it. And the rest is specific strategies with retail, which is single tenant retails that are vacant properties, like an old Jack in the Box. Put it under contract vacant, maybe around 600, 650. And then we don't buy it. We have 45 days to line up a tenant and 15 days to close. So I just call national tenants. And then all I need is one national tenant to come in for a 10, 15 years lease. And that makes the property jump in value to, let's say, $1.2 million, $1.4 million, even $1 million only. Big big upside, no downside. If we don't line up with tenants, I just walk away. And I've trained students in my education company to join me. They find the deals, they use my proof of fund, they line up the tenants, we go on conference calls, I close the tenant, and then I pay them on that upside. So it's extremely profitable, and it doesn't matter where the market is going. It has worked out for me very well through the years, actually.
That's incredible, man. So you get the property under contract, you find a very good commercial tenant to place before you even close on the property. So by the time you close on the property, the value has just skyrocketed
Exactly.
from what you had it under contract.
Yeah, otherwise I'm buying a problem. I'm buying a vacant property that needs some rework or refurbishing to get to the next tenant. But at least when I line up a tenant, the main conversation is, well, if you want me to pay $100,000 a year triple net, that means they paid $100,000 plus tax, insurance, and maintenance. You need to kick in $100K. Okay, I'm getting it under contract at $600. I'll kick in $100K. That's $700,000 my total cost. But when they pay, let's say just they pay $60,000 a year, like that's the lowest rent ever, like $5,000 a month for these national tenants. That's $60,000 a year in net income on a property that has a national tenant for 10 to 15 years with corporate guarantee, make the property worth $1 million plus because it's 6% cap. The cap rate, the capital works of $1 million at 6%. So I'll give them 100. I gave actually one time 150,000 to a tenant to come in because the value was jumping $500,000. Now, I used to do it by myself, and I built a big portfolio in Old San Juan, Puerto Rico. So it's $100 million portfolio. You can see it at CREPR.com, like commercial real estate Puerto Rico.com. It's where the cruise ships arrive. So I had 41 commercial buildings there, and I sold 15 kind of to pay off half the portfolio, and now the other half has very little debt. But that's my personal portfolio. The important part is I train people to find the single tenant throughout the USA. Like we're doing a deal in Atlanta now, but I'm in California or in Puerto Rico doing another deal in San Francisco and stuff. And the thing is, it's always the same. If there is no tenant, we don't buy it. If there is a tenant, we work out the deal for the tenant to make financial sense, and then we lease to them. If they want to sublease to a franchisee, that's their business.
Got it. How does I love this, man. I love this creative deal structuring. How does the financing work there, right? You've got this deal under contract. Are you getting bank debt on that? Or is this kind of because the total price on this is maybe $600,000 or $700,000, you're able to come out of pocket for that and give you more flexibility on the deal? How are you structuring these deals? Because if you go to a bank, right, they want to know exactly what you want.
You're absolutely right.
They want the numbers. And then you changing it kind of last second and say, oh, I got this commercial tenant. Now I want you to loan me more money because it's worth this much more. Changing that stuff last second, they probably don't love. How do you?
So, okay, this is great. It's a very practical question. I like your question. So we put a property under contract at $600,000. We really show proof of funds. I'm going to buy it all cash because I have credit lines. I like credit lines.
Yep.
So I said, look, I'm going to close within less than 60 days. My competition was going to make you an offer. They're franchisees or they want to get small business loan. It's going to require 90 days for them to line up everything. Then another 30 days to close. I'm fast. I'm 45 days. We'll go hard on the money, non-refundable, but I'll just give you 5,000. And here's the proof of funds. So then I put the deal under contract at, let's say 600. We'll work with the same figure. I start smiling and dialing. I line up a tenant, a national tenant, or I train people to do it, like that work with me on the program. And then what we do is when a national tenant is ready to discuss it, we go on a Zoom call, discuss the letter of intent, lease for 10 years, 3% escalation. It's a triple net lease. That means you'll pay the lease plus tax, insurance, and maintenance. We give us a corporate guarantee. We're going to kick in 100,000 rehab or whatever. As you rehab the property, we release the money through escrow. And now I go to the bank, like you asked for the finance. I go to the bank. I say, Mr. Banker, Mrs. Banker, I got right here the contract to buy this property at 600,000. They immediately look, and if they're fast, they're going to say, okay, this is a vacant property, single tenant. And I said, but wait, I got this national tenant coming in. And they say, oh my God, this is great. They're going to pay 5, 6, 7,000. Usually the average rent's like 8,300. That's like 100,000 a year. So they take it and they say, we're going to go through the underwriting department. And no matter what, we know the property is going to jump from the 600,000 under contract to $1 million, $1.1 million. But we're going to tell you what we need in down payment. Usually the down payment after they check that the tenant is coming and there's a corporate guarantee, down payment is going to be between 20 to 30%. They're going to give 65, 70 to 80%. It depends on the relationship with the bank. You do it a couple of times, you're going to get the 80%, no problem. But so let's work with the 30%. So I'm going to have to come up with $180,000 cash down payment on the 600, and they're going to give me $420,000 loan. So now the tenant comes in, we sign the lease because now the deed is in my name. We sign the lease with a corporate guarantee for just, let's say, 10 years on. And once we sign the lease, the property now has a debt of 420, but I can sell it anytime at $1 million. So I go back to the same lender as soon as they usually get a couple months free rent. As soon as they start paying, and I go to the lender and say, listen, I know I have a prepayment penalty. Would you refinance for me and cash out my down payment? I used to, in the old days, I used to cash out more than my down payment based on the value of the property. But if I refinancing and cashing out in the first year, which is what I do, I cash out just the down payment. So I have no money in it, literally speaking. So they see that I gave the rehab money and I gave the down payment, so I can get back my rehab money and the down payment. That's the maximum they'll give me. So I cash out my 180 plus the 100, so 280 out. So now I have on the property $700,000 loan on a property worth $1 million, $1.1 million. And the beauty is it's like infinite rates of return on endless streams of income because these tenants are staying. You got, like we're working right now with this national car wash company in Decatur, Georgia. Now, if you'd asked me where is Decatur, I didn't know. But I had a student. We trained the student. He went, got the deal, and put it under contract. We had simultaneously a tenant wanted to come in and a buyer who said, I'm a franchisee. I know you don't want to take franchisee. I don't give corporate guarantee, but I want it. I want that location. So I had so many choices. So we bought it. And, the upside is $425,000. So the student who got it is going to make 10% on the upside. He literally just made one phone call, another phone call, and now the deal is together. He's going to make $42,500. And all that upside, we just buy it, we'll put it, refinance, eventually cash out, or we turn around and sell it. Now, when we sell it right away, it's most people will pay capital gains. It's better to wait. A short-term capital gain is better to wait a year. But I have, many ways to reduce my taxes, etc. And that's where my structure in Puerto Rico helps legally. My headquarters in Puerto Rico, so I can reduce my taxes legally because it's a business machine, if you will, that has quite a few people working with me.
Yeah. So are you closing the actual real estate deal with cash with the seller, and then simultaneously working on that bank loan in the background?
Yes. Now I because I have credit lines, I paid off a lot of buildings and I have credit lines. So I just show the brokers, hey, and let's say you're working with me, Seth. I'm going to say, okay, you tell them that you're working with Cherif Medawar, so your offer and or my LLC. And then you show with the proof of fund, which is a letter from the bank saying Cherif Medawar has so much in deposit. Cherif Medawar has credit line with us. He's in good standing. They verify with the bank. And now the deal is done. I buy it all cash from the credit line and we replenish the credit line when we sell or when we refi. But when I started, I actually didn't have, I did deal with cash advance on credit cards. You know what I mean? But it works.
Yeah. And these national tenants, you're able to close them that fast and get them to sign in, let's say, 45 days or whatever that timeline looks like?
We at least get them to say, yes, we're interested in this. We have the letter of intent. And then I actually have them send somebody to measure and give us the blessing so they sign the letter of intent. It's non-binding. It's not like they will have to do it, but they can actually change their mind. But only I tell you, honestly, no exaggeration, 1% chance after they spend the time and effort to negotiate the deal and send somebody to bless it for them to bail out. I mean, I've been doing this for decades, and it made me very wealthy in the shortest period of time possible. Then I got a little lazy holding a portfolio and just cash flowing and doing seminar stuff like training people. But I remember the only time I had a letter of intent that they didn't go through was with Liz Claiborne company under a division called Juicy Couture because she passed away. I sent the contract to sign. I mean, the attorney had drafted the lease. We had agreed on all the points. And I'm calling on Friday. I said, I sent it to you yesterday. Call me back. And then Tuesday, I get a call back and say, you didn't see the news? She died. She passed away. She was like 76, I guess. I mean, so it's unfortunate, but the building was so good because if she was interested, if the company was interested, another company would be interested. Some deals are better than
Yeah.
others. Yeah.
Yeah, this is incredible, man. I love this creative deal structure. This is pretty new to me to hear, so my ears are perked up. I love this, man. What do you think is the biggest risk in executing one of these types of deals?
Okay, so the biggest risk is I notice some people, I train them to do it, and then they get too excited. They get a franchisee or a weak tenant instead of following my formula, which is get only a national tenant, because the national tenant are usually publicly traded. They're in multiple states. So when they sign the lease, there is an attachment form that says this is a corporate guarantee. This lease is guaranteed by the corporation publicly traded under this. They go get a weak franchisee who's starting, somebody with a dream. He or she is cooking some cookies and they think they're going to make it happen under franchise of whatever, but they never ran a business. So even though it's a franchise and they are going to pay good money, they don't last. So then that person who bought the building to put the tenant is not able to get the maximum loan. He's going to put 35 to 40% down payment. Number two, the tenant, as soon as there's a problem, they fall out and say, okay, I can't make it. So if they follow the formula of the national tenants and the corporate guarantees or franchisees that have at least 20 units and been in the business, so the quality of the entire structure has to do with the location of the property and the tenant power to pay. Then you structure the formula of the lease. And I do the training from A to Z. I do it myself. I don't assign it to anybody. I'm a small education company, but that's why I lasted 26 years training people and educating them to the next level.
That's fantastic, man. And then what do you think is the hardest piece to execute here?
Oh my God, man, I love your question. They're so practical in terms of the application, Seth. So the practical piece. So the question is, so Cherif, why don't you do it by yourself? Why are you telling people and having somebody in Kansas, somebody in Miami and all this? Because the hardest piece, Seth, is the one when they get the property under contract, because that's the easy part. Hey, I have a proof of fund. I like your property. Let's put it under contract. The hardest one is when I give them a national tenant list, 4,500, and I give them the script and I say, you got to call the tenants, send them this video, say this, leave that message, be able to follow up. And then tomorrow send like a bunch of other tenants and follow up with the old ones. And the third day it compounds on itself. So the follow up with the tenants is the hardest part. That's why I tried virtual assistants, didn't work. I tried to work with brokers. They just wanted this property. So I said, I'm going to train my database of people. They're going to make a lot of money with me. By the way, I have over 1,000 video success stories on YouTube. There's no education company that has that. None. You can look online, put Cherif Medawar and you will see. Because these people who said, okay, I'm going to focus half an hour a day and make some calls and then answer any emails that come. All you need is one tenant. I mean, there is a degree of luck. You can line up a tenant within 10 days. And they say, okay, they send you an email back. We saw the video. We got your voicemail. When can we get on a call to discuss detail? That's when they forward it to me. And we get on a conference call on Zoom and discuss, okay, the terms and this and the traffic and who will come and visit it on site. And we close on the deal. Or we assign the deal like sometimes they want to buy it. Especially since 2022, 23, there have been a lot of, like we get a deal under contract, 600. They say, okay, we want it. And we say, well, we want 725. And they say, well, it was listed at 725. Don't you have it for less? Well, we're going to close and buy it anyway. And when we buy it, we're going to sell it at 800. Do you want to come in? Okay, we'll assign it to us. We assigned even to McDonald's one time. And they're not so easy to deal with, but they like the location. They're like all in, man. So yeah, that's the hard part, is that people have to follow up on the calls with the tenants.
So finding that great national quality tenant, and there's just all the follow-up and the due diligence it takes to actually secure that tenant and to do it quickly, right? Because we're talking about this 45-day timeline to do it quickly. So you got to be on it and follow up and answer those emails and make those phone calls.
Well, actually finding the tenant is like, you have to contact so many tenants and follow up again with so many kind of builds on itself. But within 2 weeks, you will know the momentum you're getting. You start getting some emails, questions, and then one of them says, I want to discuss it further. And then once we discuss it and it's LOI, we don't do anything. Like I don't do due diligence. Like I'm not going to go, none of my students that are, I call them joint venture partners. None of them go and inspect the roof, or we don't inspect the AC units. We don't do any due diligence. We just put it under contract, call the tenants. The tenants then come in and take a look. Then they do a follow-up call saying, okay, We discussed the letter of intent, but we need to change the floor. We didn't realize that we need you to kick in another 15K. This is pennies compared to what the value will be. So this is when we just finalized what I call it the nibble. They always want to take something at the end. Sometimes they say, no, I'm not going to do it. If you want the property like this, we have another tenant lined up. So they say, okay, fine. But we don't, the easy part is getting the deal under contract. And once we get a tenant interested, that's it. We're done. We're just like, when do you want to close? Because they take it from there. The hard part is following up with the tenants and being able to negotiate the part of the letter of intent, because these guys negotiate for living. They do it with big malls, but they like standalone buildings because it's total autonomy for them.
Right. Yeah. And that kind of got into my next question, which was about like, how do you do all this due diligence, right? Like that takes a lot of time when you're closing commercial property, and it's typically a 90-day close. Maybe you extend it again to 120 days, but you pass a lot of that off to these tenants that you secure.
So what I do is, we have 45 days due diligence and 15 days to close. We don't spend any money on the due diligence in the 45 days. Because if a tenant is interested, they already do some workout online. They check the traffic, they check the neighboring tenants, they check all the stuff they need, and they say, okay, we're interested. So then I can go hard with the money and then add money. Usually at that point, they say, okay, we need you to put more money. We'll put, let's say, 45,000 more or whatever. And if I'm working with one of the students, a joint venture partners, I actually literally give them back the 5,000, and then I go in with the hard money that's not going to be refundable until we close. They get on the upside 10 to 15%. If it's a 400,000 upside, like from 600,000 under contract to $1 million when the tenant comes in, and we signed up for 15 years, which has been happening since COVID, because people are so afraid of high inflation, so they sign 15 years. If it's a 15-year lease, I give them 25% of the upside from the contract price to the formula of 16 times what the base rent is, because that's a 6% cap. So if the tenant is going to pay 60,000, go times 16, it will be like $1 million, it'll be 996 or something. So I tell them, don't worry about how much I'm going to give them in TI, tenant improvement. The contract is 600. The value is 16 times that is $1 million. I'm going to give you 40,000. Oh, they signed for 15 years. On that 400,000, I'll give you 100,000. So, but in that extra 15 days to close, that's when I run title, see if there is anything I need to know. And then I let them, or we usually have like that phase one, for the, like I just closed on a property and we had to do a survey, what's called phase one for the, my God, the name escapes me right now. Environmental, thank you. And we didn't even have a survey on the property, and the deal was done. We didn't have a survey. They didn't have it. We didn't have the drawing of the space. It was an old Sonic building, but deal is done. Why? They want the location. They want location.
Right. And because it's single tenant, triple net, long-term, corporate guarantee, it's all on the tenant for anything that goes wrong with this property. So they're
I mean, the properties I held, like in Puerto Rico, I got buildings in Puerto Rico. There is Old San Juan where the cruise ships arrive. So many years ago, I went to, because I heard about tax benefits and it's a great place. So I went and I bought just one building. I bought it, had 2 retail spaces downstairs and a big apartment upstairs. So when I bought it, I realized that the cruise ship traffic passed in front of the building. And if the tenants were leaving when I bought it, that's why the guy was selling it. If I remodeled the spaces and put jewelers downstairs or nice retail shops, it's going to pay for the whole building. So I ended up buying my first deal, get great tenants, and they advertised in the cruise ship. So the traffic was coming in. So the people next door actually told me, instead of doing the same thing, they told me, do you want to buy it? Because we're moving to Florida. So I bought next door. On that street called Tanca Street, I ended up buying 9 properties. And then another street, Cristo Street, I ended up buying 12 properties. And then on Fortaleza Street, another street, I ended up buying right and left. I couldn't buy from owner-operators like the jewelers that own their own buildings, but I bought from everybody else that says, oh, my kids left to New York, my kids left to Florida and whatever. Do you want to buy? You're a crazy guy buying, and you have to remodel. And yeah, guess what? I would remodel when I line up the tenants. Sunglass Hut came with me in 2006, for example. They're still with me here, and that's what, oh my God, that 20 years later, they're still with me. I had Coach forever. When I bought the Coach building, I bought it, the tenant was leaving. So I bought the building knowing the tenant is leaving. I had lined up another tenant. So Coach, when I bought, I called them. I said, so when exactly are you leaving? Because the seller told me, and they said, we were so frustrated with the seller. He didn't want to fix anything, but we're going to find another location. I said, wait a minute, you want it to stay? And they said, yes. Okay, what do you need? You will need some roof, this and this and that. I changed them, and they moved to 15,000 a month from 8,000. Through the years, 30,000 a month they were paying, making 8 million a year in gross sales. Great location, great tenant, corporate guarantee, never an issue. Never. Like I never had to tell them during COVID they paid. What?
Yeah.
You know, so anyway.
Yeah. Yeah. And then I think you had mentioned this earlier, but and you have minimal at risk here, right? So you said you put about $5,000 down, or it probably depends on obviously the buy price, but you put minimal down. Is that ever a challenging conversation to have with the seller with just
sometimes the brokers say, okay, why only 5,000? And we say, well, here's the proof of fund. So then they say, can we call the bank? Call the bank. So then the bank says, oh yeah, Cherif has credit lines. He takes them out. He pays them back. The money is available. This is true. So then they call me, like sometimes the student that I'm working with, the JV partner, joint venture partner, says, okay, the broker want to talk to you. And the broker calls me. So, okay, so what is this all about? You guys, why don't you put more upfront if you have so much cash? And I say, well, okay, look, we're doing simultaneously many deals. It is my portfolio. Go to CREPR. It's a 100 million portfolio. I'm not playing around. And we buy and we either place tenants or we just operate them ourselves, like literally get the license agreement, approve that, then sell the whole package, whatever. So then they say, well, can you put 25,000? No, because simultaneously I'll have 500,000 in deposits with no interest or whatever. Right now we're making 3.5 to 4% in the bank, money sitting. So then why lose the money on deposits? So then they go for it. Sometimes they ask for an extra 5 and stuff, but actually I'll tell you 8 out of 10 deals, the 5K is fine because they see it's a quick deal. It's an all cash. We don't need appraisal. Appraisal doesn't mean anything for us because we don't buy it unless a tenant is ready. And moreover, let's say you're working with me, Seth. So I'm training you on how to find the ideal property, what to tell the broker, show them the proof of fund, and then go ahead and call these tenants, do a video of the place, take these photos in a certain way, send me that email with the video link attached and stuff. I approve it, make it change a little bit. You start calling on the tenants and all this. So what happens is you're presenting a package. And if for 44 days on your 45 days due diligence, no one called you back, like, God, it's like sucking wind, okay? You don't have to buy. Yeah. You just call the broker and send an email to the escrow and you say, deal is not for me, I need to get out. And they refund you the 5,000. There's no downside, huge upside. It's honestly, I don't know why people, like, I can't stand apartment building. I think it's amazing that people can make money. I buy them, I sell them. I buy them, I split them into condos and sell them. I buy them. I have 12 units because it's also in a destination location, but converted it all to Airbnb. And we have an amazing system with Airbnb in destination location where we beat hotels and make very good money. The flow through is insane. But to run an apartment building with leases that are 6 months to a year or 2 years, then the 2 years doesn't mean anything because the guy got sick or the lady is relocated or they just got an extra kid. I have to have a heart. I say, okay, don't worry about the lease, move on, But corporations, publicly traded, do you know if they cancel the lease, if they sign a 10-year lease, Seth, and then 2 years into it, they say, okay, this is not working for us, we need to leave. They have to find another tenant to replace them. So I end up with 2 corporate guarantees. If not, they have to buy the lease from me. They say, okay, so we have 8 years left on the lease. It's 100,000 a year. That's 800,000. Can you work it out with us? Can we give you just 500,000 right now and discount our obligation? Because they have corporate guarantees publicly traded. I will win the case every time. And I had Puma Corporation leave that, but it was a 20,000 a month lease. They paid me $1,057,000 to get out. Burberry, they paid me $1 million to leave because they changed their plans. These are publicly traded companies. They print money. But you lease to a mom and pop and they have an issue, you got to say, okay, well, God bless you. I'll try to refund you the deposit or at least give me a notice a little bit earlier so I can, go find somebody to replace you. You can deal in a small game or the bigger players that will make you the money.
Yeah. And I love it, man. Pardon the interruption, but we don't do ads. Instead, know that if you're raising capital for real estate, my law firm, Raise Law, is here to give you the expert legal guidance you need to raise capital compliantly and structure and close your deal. And if you're looking for a done-for-you fund-to-fund solution, TribeVest is the industry's only all-in-one setup and fund administration solution. Visit raise.law and tribest.com to learn more. And I'm a securities attorney and a fund manager myself, so I can't help but think, the wheels are turning here, right? I can't help but think about how this structure would work within a fund and how amazing it actually sounds, right? We're talking about low risk. We're talking about this massive value add component that you can put in place right out of the gate, even before you close. Yes. You're able to refinance quickly, so you're able to return capital to your investors potentially really quickly, and they want quick wins, especially in today's market when you're raising capital. They want quick wins. They want to see cash flow, and then leaving it to cash flow, and then they're cash flowing properties. So there's just like everything is like a green light here for a fund, and especially right here today, like I said, because people are scared of multifamily. They've been burned by multifamily investments in the past. They're part of deals now that aren't cash flowing, or, there's been capital calls, things like that. They're looking for quick wins. So anything that they invest in passively right now today, you see debt funds, you see oil and gas, see things like that, because they're going to get some sort of cash flow, let's say day one or in the first month or the first quarter. This sounds like this could work for that as well. They're going to get some quick wins.
You're so right. Actually, we set up this guy. I'm giving the example on the 600,000 because we had one of the people set up a fund. He took the training with me. He went, did the first deal. He assigned it to me. So the upside was 500,000 something. He got, anyway, his assignment fee was 51,000. So he said to me, you know what? I've been doing these small apartment buildings. I was so clever with 30 units. When I sell them, they sell very quickly and whatever, but it was a grind. He did wholesaling of residential. So he did this, and he went set up a real estate fund, and he had one property that he bought for himself. I helped him do the whole deal and negotiate the lease and everything. So he put about 200,000 down. That's all he had in cash that he had saved in his life with all the work he was doing, and got a $400,000 loan. Okay. So the property was cash flowing because it was worth $1 million. So when he set up the fund, he came to me and he said, can I put this property in the fund? I said, yes, the way you have your private placement, you can do it. So he literally raised 200,000, cashed himself out, and put that asset was an LLC instead of him as the owner and his wife. They put it all as the fund. All the shares transferred to the fund. Cashed out his 200. Yeah. Seth, he went and got another property, cashed himself again. And each property, by the time he puts the money in, pays the investors, kind of a fixed return, whatever, he's making only $1,500 per property cash flow per month. But every deal has an upside of 400,000 for him and the investors, etc. And I told him in 10 deals, you'll have $4 million of upside and you'll have 15,000 a month. He's on his fourth deal. So, I mean, you get excited about something like this. If I tell him, please stop and take a vacation, they don't want to take a vacation. They're driving around. They're calling on LoopNet. They're making the deals.
I love it, man. I love it. Yeah, it sounds exciting. I'm sold, buddy. We need to talk after this. We need to talk. Changing gears a little bit. You've been in this business for a long time, right? Like 35 plus years. I mean, what have you seen change? Like, not many people can say that, right? People get washed out. They go back to their W-2. There's been changes in the economy. There's been crashes. It's very, very rare to see people stick with a business for this long and have that much success. Like, what have you kind of seen change over those 35 years, like with your investing strategy? And, what do you say to people that, if they come on hard times? We're in one right now with commercial real estate. A little bit. How have you been able to stick with it?
So what I've seen change was the banks. The banks went from, when I started, they had the NINA loans, the no income, no asset verification loans. I mean, literally, my first deal was cash advance on a bunch of credit cards. And there were government programs or 5% down if you live in this zip code or that zip code. So that changed into then, you need to come up with the full down payment. We don't care where you get it from, but we need a down payment. Then they came up with like larger down payment. We need to know where you got the money from. Then anti-money laundering things. Then the money has to sit in the account for so long so we can see that it's seasoned. And then the next thing is, where did you get that money? And are you going to have money in the future? So it just got harder and harder. And after 2008, 2009, when the whole economy dropped, it got the hardest. It became hard. and people just got discouraged in buying and stuff. So the renters started coming in. And in 2015 was the biggest change I've seen. And that's when Obama came and created the Jobs Act. And he said, you're an attorney. In the Jobs Act, he said, let's create the Reg D 506C, which is Reg D 506B since 1933 was in a structure where an individual in the United States can raise capital from investors and go do a project with their money and pay them back. It's a security because he's investing their money or she's investing other people's money. But it was only friends and family, people with whom you had a substantive relationship. You could not publicly advertise. In 2015, he came up and it was a great thing. I mean, Obama, I don't know why he doesn't get enough credit for it, but he said, let's go ahead and do this incredible thing where we can open it to public solicitation and get accredited investors, those with a higher net worth or higher income, and then go have at it. So it was a complete transformation. Now, any person can set up a fund or a syndication. Syndication is when you have one asset, only a fund when you can put many assets. And they come up with crazy numbers and say, give me the money, I'll give you 25% return per year. And people threw money at these people and they lost their butt. And it's not the problem of the sponsor or the syndicator or the fund manager. A lot of it was the market. I mean, heck, I was in San Francisco and I could see how the market got collapsed mid-2024. Collapsed. San Francisco went from the best city to a disaster. So that was a big change. So people now are too apprehensive. Where do I put my money? What do I do? I'm so scared, and the banks are scared, and investors are confused. It's just, and through the chaos, those who know what they're doing are making more money. This is amazing.
Yeah. How do you talk to investors right now that are kind of apprehensive and maybe they've even lost money in a passive investment? Like, how does that conversation go? I've heard other people say like, hey, they're kind of a lost cause at this point. We're moving on. We're obviously going to help our investors and try to save those deals. But as far as getting new investments from them, they're done.
Yes,
they're not going to do it anymore. So we're going to focus on new investors. What's kind of your
I
strategy?
tell the investors, if you're going to invest in a fund, find out, first of all, the track record of the person, even though the past doesn't mean the future. Number one. Number two, how much money are they putting in these deals? And are they getting the loans with their personal guarantee? Or is it going to be your money, other investors' money? Is going to be a non-recourse loan, and they come in making their 3-4% acquisition fee, their management fee, and upside, and there is no risk on their side. Actually, I heard, I was watching some of your videos just to be prepared for talking to you, to know your style and all this. I know we talked before, but I wanted to see your style of interviewing, and it's really neat because you listen and ask very succinct questions to what's being said. And one of your people said, the private placement memorandum protects you from the downside because you're going to put all the disclosures. But then some people did it in a bad way. They said, I'm going to take big risk with other people's money because the loan is non-recourse. We're putting 35% down. Let's see how it's going to go. I'm going to make my 3% acquisition fee anyways, 150K I'm going to make. What I'm going to, and guess what? These are the people that were calling me a couple of years ago on Facebook. Hey, Cherif, would you like to buy this at 80 cents on the dollar? That's the loan package and all this. Investors will lose 100%. I'm like, right, everybody can have losses. That doesn't mean it's a bad syndicate or sponsor or anything is done unethical. But to go in such risky deals and not be prepared is a problem. And the problem was compounded with so much going on. I mean, till now, we got all this stuff going on. We don't know what's going to happen. The interest rate dropped to less than 6%. It was 5.94. I'm talking to the lenders now. And then they said, listen, with the Iran situation and the oil price and all this, now it's going to go to 6.7, 6.9. So it's like, okay, so what do? You just work on the cash flow. So I tell the investors, if you don't invest comfortably with somebody in their structure, go find the cash flow and profit. Do the deals with the single tenants. Maybe even buy a deal with the tenant in it at 6%. You're going to have a Jack in the Box paying you 6% for the next 15 years. How bad is that? Okay, you're going to have depreciation, you're going to have escalations of rent, you're going to beat inflation, and you're going to pass it on to your loved ones.
Yeah. I mean, cash flow is the name of the game. I think we got away from that because there was, the market was so good for so long there, basically from 2010 till 2022, 2023, beginning of 2023. Yes. And the market just saved everybody. So there was just so much appreciation, so much rent growth. Everything was going in our favor. And nobody really worried about the cash flow because it was like, who cares? Our building is worth so much more now than it
So
was when
true.
we bought it. We're going to sell it. All the investors are going to make money. We're going to make our, our profit split, our carried interest on the back end. No problem. All good. Everybody's happy. And then the floor fell out, and now everybody's stuck on these properties that don't cash flow at all.
Yes.
And that's a problem. And that's a problem for everybody. It's a problem for the investors because they can't take risk off the table because they're not getting any cash flow in
Very
their
good
pockets.
point.
And it's a problem for the people that raise the capital or are the actual operators that aren't getting any cash flow because there's no motivation.
Yes.
Right? They got paid maybe an acquisition fee or something at closing, and then they planned on getting a big payday on the sale on the backside or maybe in the refinance on the way. Now they're stuck and they can't refinance and they can't sell because there's no big exit on the horizon. So now you're just stuck with this asset that doesn't cash flow. It's not appreciating. And you're really just holding on. And
Exactly. And sometimes you don't have the time to hold on because the investors are
Right.
starting to panic and say, I want my money out. So you have a run on the fund or a run on the syndication, and it becomes very problematic. Yeah.
For sure, man. In a parallel universe, tell me about a different version of you. Not in commercial real estate, because that, you've been in it forever,
Yes.
man. So it's probably a hard question to ask, but, tell me about, that different version.
I loved hotel business. I started in hotel business. In a parallel universe, I would have stayed in the hotel business, continued running hotels. I tell you, I was so excited. I was recruited from the Century Plaza Hotel, a 5-star, 5-diamond hotel in Century City and next to Beverly Hills in Los Angeles, by a billionaire when I was in my early 20s. And I went to work for him. But imagine if I wouldn't have gone with him, I would have stayed with Westin Hotels, moved up through the ranks, became vice president with, big companies like Westin or Hilton, because I worked for Hilton as well a little bit. And I think I can't tell you how happy I was because he had a resort. So even when I went with him, I was based in the resort. Then I would travel, do these for him, etc. I couldn't wait to wake up in the morning to go back to work. And I was working 10, 12 hours. I mean, I got married very late, like I was 38 years old. It's not that late, but I mean, it was late because I was so busy between hotels and investing. So I would have stayed in the hotel business, and I was a great guy at it, and I loved it.
Yeah. I mean, that's how you know you're doing it right, when you're looking forward to it, when you wake up in the
Yes.
morning and it's not, oh, no,
Yes.
dread,
Yeah, that's
gotta go to work.
terrible.
Like you're like, pop out of bed. You're like, yes, let's do this. That's awesome. Awesome, man. Hey, this has been incredible,
Thank you.
Cherif. Where can our listeners find out more about you?
Okay, they can go to www.cmrei.com. It's right here on the screen, which is Cherif Medawar Real Estate Investing. cmrei.com. And they will see my programs. We help people do these joint venture programs with me. We also have a good asset protection program if anybody's interested to protect themselves. And we talk a lot about training in different type of commercial properties, how to make it. Now, my favorite is retail and hotels, but there are so many ways to make money. It's almost hard not to make money. If you follow certain principles, the money is in the structure. And the structure, the ultimate structure, is a real estate fund, because you'll work with other people's money and everybody will make money together when it's done right.
Man, fantastic ending there, man. Money is in the structure. That's where it's at. All right, brother. Thanks so much. All right, big brains, that's a wrap on today's episode with Cherif Medawar. If this conversation shifted how you think about deal structure, capital raising, and what it really takes to build a commercial real estate empire that lasts, that's exactly why we do this on the show. Do me a favor, leave a rating and review on Apple Podcasts or Spotify. That's how we keep attracting operators like Cherif and delivering conversations that actually move the needle in your business. Check out the show notes to connect with Cherif and learn more about his funds and education platform. And of course, go to SethBradleyESQ.com and grab the Fund Founders Playbook. It will be the first step that you need to take in order to launch your first or your next capital raise, fund, syndication, acquisition. We're here for you. As always, enjoy the journey and raise the bar. Thanks for tuning in to Raise the Bar Radio. If you enjoyed today's episode, make sure to subscribe, leave a review, and share it with someone who needs to hear it. Keep pushing, keep building, and keep raising the bar. Until next time, enjoy the journey.